Hi guys, this is Richard Yi. Today is June 24th, 2011. So today I want to talk about speculation in the financial market. Because when government officials or financial commentators, economists, when they talk about rising prices, they usually blame it on speculation in the financial markets. Because first, rising prices has really a significant impact on the economy. Because, for instance, many prices like oil or food or other resources, they have really significant impact on the economy. So by blaming them for by blaming the speculators for rising prices, they the government officials they can have a really good scapegoat to get away with the responsibility of slow economic growth. Here are some critics towards speculation.
This Memorial Day weekend, families all across America have canceled their travel plans. Others are digging deep to pay $60 for a fill-up. And $10 of that $60 is going to speculators on Wall Street.
Well, members of the House and Senate have been highly critical of the CFTC. Is speculation distorting the energy markets, and have you not done something about it?
Well, I think, Michael, that speculation is a component. I mean, obviously there's other major factors, the things that you've been covering today, Nigeria, the dollar is a huge impact on oil prices, etc. But it seems to me that speculators have some impact. There's $250 billion in these markets that weren't there just a few short years ago. And I got to think that has some thumb on the scale impacting prices for consumers, and we've got to do a better job trying to filter that out.
However, today I'm going to defend the speculators because far from causing economic downturns and other related recessions, it is the speculators who prevents rising prices. And far from safeguarding the lives and the economy, the well-being of the economy, it is the government officials or the bureaucrats who really cause the economic downturns. Well, first, speculators are people who buy at a low price and sell at a high price, hoping to make a profit. Right? Buying at a low price or increased demand at a low price will bid up the price of the asset because of scarcity. When price goes up, speculators they realize that they can make a profit, so they sell their assets, and therefore they make a profit. The reason why speculators have the incentive to buy low and sell high is because he forecasts a shortage in the future, which will cause higher prices, right? Whether that shortage is caused by bad harvest of crops or shortage of oil due to war. In a sense, speculators they buy and store the asset. Here in this case, we use gasoline. Okay, say there's a speculator and he forecasts there's a shortage of oil in the future because of war in Libya. Okay, and right now the oil price, they're definitely to him the oil price is undervalued, right? Therefore, and the supply is plenty. Therefore, he buys the oil, and his action will push up the oil price, right? And here's why why people criticize speculators for high prices because their action pushes up prices, and they claim that people are suffering from the high prices and therefore the economy slows down. Well, no, no. Why? Then here comes the interesting part, because his action pushed up the price of oil, and remember, there's a producer for oil, right? The producers of oil they see the higher prices and they're being encouraged to produce more of oil to satisfy the increased demand, to make more profit for themselves. And the producer's action also increases the supply of oil, so therefore in the future there won't be a shortage of oil. And also higher prices will tell the consumers to consume less so that the more supply can be served in the future. And that is a signal that's sent by speculators. But what if the speculators are wrong, right? What if it predicts there's a shortage, but it turns out that it's a really good harvest in the future? What happened to that? Well, humans are not perfect beings, right? We make mistakes because we don't possess perfect knowledge in the present. So there's always uncertainty in the future. Right? So therefore, it is reasonable for speculators to make mistakes. But since speculators are such an important mechanism in the market economy, they provide information to producers, to consumers. Then what if they're wrong, right? But the market has a really good mechanism to prevent those mistakes, or I should say minimize the mistake. because if a speculator keeps on making wrong decisions, then he would have less capital to speculate. Thus, he will have less influence in the decision making of the economy. And besides, since speculators are investing with their own capital, they will have really less chance of making mistakes. So now we see speculators are actually heroes of a society. In fact, they produce information to producers and consumers about future shortages. They help society avoid shortages, and they help allocate resources in the economy. Speculators, therefore, are not unproductive actors that slow down and give risk to the economy. So next time when you see financial commentators, politicians, or even economists blaming speculators for causing high oil prices that will slow down the economy, well, you can laugh at them right now because you know they don't know what they're talking about and they're wrong. So thank you for listening, and hopefully I'll be vlogging again soon. And take care. Bye.